Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, at our last roundtable, our panelists each provided their 2009 outlooks as far as stocks and sectors were concerned, to stocks to consider buying, sectors to consider buying, or avoiding for that matter. But upon further review of the tape, as they say in the NFL, we discovered they had not provided their targets for the stock market. Well, we weren't going to let them get off the hook that easy. So we'll ask them to provide it today. This time around, they are Editor-at-Large Steve Reitmeister, Value Stock Analyst Tracy Reinick, and Zacks top stock screener, of course, Kevin Matris, all here at the round table. And I just want to say that I find it kind of curious that Charles isn't here today. What we're going to talk about, but that's me.
We're not going to let him off the hook with that one.
So this is what everybody wants to hear. Last time, you guys did a very good job at telling us what stocks and sectors to consider and not consider. But what about the Dow? Where's the Dow going to end? We're just going to stick with the Dow, right? Not the S&P?
So, today we're going to lock down some specific targets, and I'll take the first swing at bat. I'm going to say 87.77.
For the Dow at the end of the year.
And that would be 1 point higher than what it closed the year at. I just don't want to be a downer. I don't want to say zero. I don't want to say negative. I'm just going to say plus 1 point.
Okay.
And the reasons for that is I kind of lay that out in the outlook. I think there's going to be some artificial optimism at the first part of the year. I think people are going to say, oh, new president, new stimulus package, and things of that nature. Mm-hmm. But then, just like 2002, they're going to realize that their optimism was a little too early. Mm-hmm. The market will probably try and find a bottom again. It may just test the bottoms that we already had, or may fight to a little bit lower. And then I think that in the second half of the year, I think we will be finding our way back up. So when I say, basically plus 1 point, it's not going to be just like a straight line all year long. I think it's going to be a roller coaster ride, up, down, and back up, and ending up about where we started. Yeah,
I actually saw some analyst on the wire here late last week predicting that the graph of the Dow for the year would kind of resemble the design on Charlie Brown's shirt.
Or a heartbeat. Yeah.
What do you think, Trace?
I agree with what Steve was saying, but I'm on the more bearish side, is that I don't think we're going to see the upturn in the second half of the year. And so I'm going to predict, after consulting my magic 8-ball, about 65-25, which would put us at about 1997 levels.
Okay.
But similar reasons what Steve said, I do think we're going to see some kind of rally and we're going to go higher and then we'll go back down, but I just don't see the second half. I'm not as optimistic in the second half as other people, and I think there's too much systemic change going on in the economy to have the rebound.
Do you think this is going to be a very slow recovery?
Ultimately,
in the stock market?
Yeah, ultimately.
Interesting. Maestro, this leaves you.
I'm
writing these down, by the way.
I'm the most bullish person on this panel, which surprises me, actually.
If you add mines and Tracy's together, that's about where he's going to be, I think.
I think when we were talking about the end-of-year roundup, I said that I was more bullish than bearish, and I still am, because I believe price and time has gotten ahead of itself. Mm-hmm. If you were to look at the speed at which the market had come down, the first 10 months of this bear market, we saw the Dow Jones lose 3,370 points, or roughly 28%.
Right.
In the next 4 months, we saw the market lose an additional 3,370 points, with the overwhelming majority of that happening in just 1 month, October.
But that's all history.
Yes, but check it out. So, in order to look at the future, I got to look at the past. So when we saw the market make new lows in November, those prices were flatly rejected, and we had been recovering ever since. So I believe we are going to 11,000. And there's 4 reasons for this.
By the end of 2009.
By the end of 2009. Not 2010 or 2011.
I just had to be clear on that, that's all.
Check it out. There's 4 reasons. If you were to look at the past, you can see that the 11,000 area has provided resistance to the market as well as a measure of support. It's an important area. It's probably going to be retested. Second of all, based on the size of the base that we have, which is 2,200 points, a breakout to the upside from this bottoming pattern should project an 11,000 handle. Thirdly, if you were to look at a 50% retracement of the entire move, That projects a price of 10,008, which is consistent with the 11,000 handle. And then lastly, if you were to look at the top 10 bear markets, the one-year rally, once the lows have been put in, has been roughly 55%. And a 55% retracement from these lows puts us at 11.2, so I'm looking at 11,000.
Well, at least he's told us what he's basing it on.
Yeah, and let me just say that what he's talking about for me is not crazy. It's just when it's going to happen.
Exactly.
So I think that's the major story here. So I know all the stats that he's talking about as far as the 55% rebound from market lows. But because I'm putting the market low in the September-October time frame, and then I think we will only have a little bit of a rally from there, like a 15, 20-point rally from there, that will get us back to about where we started the year. If you are in the camp that there will be a second half of 2009 recovery, and therefore a first half of 2009 stock market bottom and recovery, and then you take that line out. Yes, 11,000 is very doable, and there's decent arguments for that. I'm just a little more pessimistic on those arguments, and I think that the recovery is further out, and it sounds like that's kind of where Tracy is as well.
And do you all agree that this is going to be another year characterized by wild gyrations? If the market goes up, it's not going to go up in a straight line. We're all pretty much on the same page with that, right?
Once we find bottom, I think you could see it go up for a while. Okay, not unlike the way you've seen this recent rally from 7,400 to approximately the 9,000 area. There was very few down days in that strong up move. Okay, from here it could be dicey for a while, but yeah, I think once we find bottom, you could have a month with virtually 2-3 days off. 2-3 down days.
So what about this notion that I'm seeing written about more and more at the beginning of this new year, that because of what's happened in the markets in 2008, because of the decimation and the down move and everything, that the new year actually could chalk up to be a stock picker's paradise?
I'll take it.
Okay.
Well, I mean, there's a point in time where the markets all move together in tandem. We saw that last year when the market came down, most notably in October, and you're probably going to see that happen on the way up in 2009, but I don't think that's going to last forever. I think it's going to happen for a very short period of time. I think there's going to be very distinct winners and losers in this recovery. And I believe that you need to look at the companies with the low valuations, look at companies with the ever-increasing outlooks for the future, healthy balance sheets, and this kind of thing. These are the companies that are going to be rewarded. The idea that you can just buy any old stock in a good group and hope that a rising tide raises all ships, I don't think that's going to happen this year. You're going to have to do your homework in 2009.
So maybe just safe to say that better opportunities for stock picking in the second half of the year?
Well, here in selective stock picking, and so that the term stock picker's paradise, that usually comes about in years that are kind of flat, okay, or that are down on the year, because if you play the indexes, you're going to go nowhere or slightly down. So stock picker's paradise is if you can be selective, and I think Kevin pointed out the things. Be value oriented, look for stocks with rising earnings estimates. These folks are going to stand out, and that's the thing is when the stock market's going higher, you play the indexes, pick randomly 10 stocks, and you're going to do just fine because the economy is going well, earnings are going well, and things of that nature. When the economy is suffering as it is now, right, you have to look, okay, to target those few companies that are standing out. And that's the beauty is, because of the way that we take a look at the market, we can find those few companies, okay, with the rising earnings estimates, with real growth outlooks, and splashing a little bit of value into it, and you can find those few stocks that investors will be attracted to, as opposed to those times when they're attracted to everything.
So being proactive is the key then?
Yeah, and I would say, look for a lot of the franchise names. Those are what's going to do well, and it has done well. The companies that are around 70, 80, 90 years, that I like the ones that have been around for forever. Right. But there's a reason they've been around for forever. It's their products and their management. I would look for that, and I would agree with what Kevin said. I would look at the balance sheets. Yeah. For sure, that's the key area right now.
What about the trend of small caps outperforming the large caps? Is that going to hold up here through the year?
That trend, which you go back to 1929, they've outpaced large caps by 2 percentage points on average per year. But here again, that's not a smooth ride either. This past year, they've actually been, they've done much worse than the S&P 500. So the thing is, on the long haul, the market goes up and small caps outperform large caps. But when the market is down, large caps get beaten up silly. Okay, because it's it's a flight to quality, and people, I don't really know what this company does, boop, and because of small float and things of that nature, that they just go away. So right now, being defensive, kind of shy away from the small cap names. But when the rebound occurs, you switch gears, you load up on small and mid cap stocks, and you will outperform the market.
Okay. Well, I'm going to actually fold this up now that I've written these down and
Time capsule.
seal them in a mayonnaise jar on my front porch. And don't worry, we won't let them forget these numbers.
Take the mayonnaise out first.
There you have the latest thinking from our panel members here at the roundtable on the Dow Target for 2009 and the whole notion of this year being a stock picker's paradise. And with everybody here, I'm Terry Ruffalo.